Good morning. It's Monday the 5th of February here in London. This is the Bloomberg Daybreak Europe podcast. I'm Caroline Hepker.
And I'm Stephen Carroll. Coming up today, the US strikes back at Iranian proxies as the risks of a wider Middle East war grow.
Jerome Powell pours even more cold water on the prospect of a March interest rate cut.
Plus, Trump has China in his sights again. The likely Republican presidential nominee suggests a 60% import tariff.
Let's start with a roundup of our top stories.
The United States has vowed to launch more strikes against Iran's forces and its proxies in the Middle East after 3 straight days of military action. American officials say the strikes are a necessary and inevitable response to the killing of 3 US soldiers in a drone strike in Jordan last weekend. But White House National Security Advisor Jake Sullivan insists the country won't be pulled into a prolonged regional conflict.
We will respond, and we will respond forcefully, and we will respond in a sustained way. I would not describe it as some open-ended military campaign. We have a concept of how we intend to respond. I'm not going to telegraph it on this show, but we will execute that concept with the kind of professionalism that only the U.S. military can bring to bear.
In a separate interview with CNN, Sullivan also declined to rule out taking action inside Iran. Friday's strikes hit 85 targets in Iraq and Syria linked to Iranian forces and militias. An Iranian Foreign Ministry spokesman called the action a strategic mistake.
The growing risk of direct conflict between the US and Iran comes as American and British forces continued to strike Iranian-backed Houthis in Yemen, including this morning, as part of an effort to end the militant group's attacks on commercial ships in the Red Sea. Speaking ahead of this latest round of strikes, the US Defense Secretary Lloyd Austin spelled out the escalating challenge in the region.
In the aftermath of the vile Hamas terrorist assault on Israel on October 7th, terrorist groups backed by Iran and funded by Iran have tried to create even more turmoil, including the Houthis, attacking commercial shipping in the Red Sea. So this is a dangerous moment in the Middle East.
Lloyd Austin there, speaking as America's top diplomat Antony Blinken embarks on a 5th trip to the Middle East since the October 7th Hamas attacks on southern Israel, which touched off a war in the Gaza Strip.
Jerome Powell says Americans may have to wait a while longer for interest rate cuts. The Federal Reserve Chair told CBS's 60 Minutes programme that officials need more positive inflation data and emphasised the risks of moving too soon. He added the potential conflict poses the biggest challenge to global economic recovery.
I think in the near term, I would point to the geopolitical risks. The global economy is broadly healing from the pandemic now. All over the world, you're seeing inflation come down. But there's a war going on in Ukraine. There's a war going on in the Middle East and potential trouble in Asia. And so all of those things represent risks.
Powell also noted that the Federal Open Market Committee is unlikely to cut rates at the next meeting. Echoing comments made during a press conference last Wednesday, the Fed chair said policymakers generally agree on the next course of action.
I think it's not likely that this committee will reach that level of confidence in time for the March meeting, which is in 7 weeks.
How would you characterize the consensus around this table for rate cuts? Is everyone on board?
Almost all. Almost all of the 19 participants who sit around this table believe that it will be appropriate in their most likely case for us to cut the federal funds rate this year.
Following Powell's interview with CBS's Scott Pelley, Treasuries fell across all maturities at the Open in Asia.
Now, here in the UK, 4 out of 5 businesses still plan on raising prices in the next 2 years. A PwC survey showed companies think that high energy bills will force them into upping charges. James Wilcock has more.
The UK hit a green record last December when it generated more wind power than ever before, enough to power 56% of the national grid. But wind is volatile. Britain still relies on imported energy and the market is expensive. Futures for UK gas imports are twice as high as before the invasion of Ukraine. Those steep rises have left 4 in 5 companies planning to inflate UK prices in the next 2 years. In London, James Woolcock, Bloomberg Radio.
Turning next to China, where the regulator for the stock market says that it will intervene to stabilise the country's sinking markets, but didn't say how. The China Securities Regulatory Commission said it would prevent abnormal fluctuations after the CSI 300 tumbled by 6.3% in January. It marks a record sixth straight month of losses. But Crystal founder Ashish Chanda says the cheaper valuations are unlikely to tempt investors back.
See, for the institutional investor, it's always difficult to take that call because it's very, very difficult to pick the bottom. But yes, there could be some offshore investors who may look at just dipping their feet in, but I think it's still catching a falling knife. A lot more is needed, a lot more details, transparency is needed.
Chanda adds private wealth fund managers like himself see rival growth opportunities outside China. Traders say weak data, simmering geopolitical tensions, a worsening property crisis and an opaque crackdown on the financial sector are driving down the country's markets.
Meanwhile, Chinese investors are concerned about another Trump presidency. According to a note written by Goldman Sachs, its clients in the region ask about the implications of an election victory for the former president most frequently. The news comes as Trump has speculated about fresh economic measures against China if he were re-elected. The 2024 Republican hopeful says that actions he took against the country were successful.
They did very well with it. As you know, we took in hundreds of billions of dollars in taxes through the taxes and tariffs.
Is that what you want to do again?
Well, you have to do it. I mean, look, their stock market almost crashed when it was announced that I won the Iowa primary in a record. And then when I won New Hampshire, their stock market went down like crazy. So, obviously, I'm not looking to hurt China. I want to get along with China. I think it's great. But they've really taken advantage of our country.
Donald Trump also shared that he might impose a tariff on China of more than 60% if he reaches the White House for a second time. The US has been China's biggest export market for more than 20 years, including $536 billion in exports in 2022. In a moment, we're going to delve into the story on China, of course. It was an incredibly volatile trading day on Friday, and frankly, today looks set up for something similar. We saw deep declines for stocks this morning in China, only to see then a rebound in the afternoon session. So we're going to try and unpack exactly what's been happening. There have been a couple of statements now by Chinese authorities. So we'll delve into that with Bloomberg's executive editor for Asia Markets, Paul Dobson, in just a moment.
Let's go first, though, to the Middle East, where the United States has vowed more strikes after 3 days of attacks against targets in Iraq, Syria and Yemen. It follows the killing of 3 US soldiers in a drone strike in Jordan a week ago. US Secretary of State Antony Blinken returns to the region today. Joining us now for more is Bloomberg's head of Middle East and North Africa coverage, Stuart Livingston-Wallace. Stuart, good to have you with us. Can you take us through the events of the weekend? What actions has the US been taking up until now, including the latest strikes on targets in Yemen?
Yeah, good morning. So it's basically we had a third day of US strikes, and this is really finally in response to what we saw in Jordan with the attack and the death of 3 US service people. So it's a measured response. It's clearly one designed to send a message that they don't want to escalate the conflict any further, but it's basically strikes on, in effect, the Iranian proxies and Iranian assets outside of Iran, so specifically in Iraq and in Syria, in Yemen, and then offshore again. And it's all mixed up with what you're seeing going on in the Red Sea and the Gulf of Aden with the Houthis attacking commercial shipping. So it's a sort of part of one big picture. But again, very, very clearly designed, I think, to be enough of a response to satisfy the domestic audience, but not enough of a response to basically force Iran's hand to escalating the conflict.
OK, that's interesting. In terms of bracing for counterattacks, what's the perspective there? What has been the reaction in the region?
I mean, I would say the Houthis aren't going to stop. I mean, that's pretty clear. They've been bombing Houthi targets now for several weeks, and there's no, de-escalation in that conflict. In terms of the other bits of the region, there's some interesting developments there. So we did see this one Iranian-backed militia in Iraq that basically said we're not going to attack the US positions anymore. Now, we haven't been able to sort of say specifically why that was so, but our assumption is that they were told to back off by Iran. Again, Iran, I think, is as keen as the US in not escalating things to the point where it's all-out war. the real question here is, to what extent does Iran control those proxies? So yes, we know it funds them. Yes, we know it supplies them with weapons and probably intelligence. Yes, we know that they have members of the IRGC, that is the Iranian Revolutionary Guard Corps, stationed in those places and therefore directing things. But do they have absolute control over those proxies? It's not entirely clear. And I would say, particularly in the case of the Houthis, yes, they have a very close relationship, but fundamentally, would the Houthis stop doing all the things they're doing if Tehran said, you got to stop? Remains to be seen. But I'm not fully confident that would be the case.
That's one set of foreign policy challenges the US is facing, and Antony Blinken will be discussing when he visits the region. Another, of course, is the ongoing Israel-Hamas war, the bombardment continuing in Gaza. What do we know about the state of negotiations to free hostages and potentially for a ceasefire?
I mean, they feel very far apart, is the short answer. And I think, we had those two relatively brief ceasefires some time ago, and I think that to some extent gave everyone expectations that this thing could keep going. But the reality is that Hamas wants a full, a permanent ceasefire, and the Israelis are absolutely not interested in that at all. And all the intelligence that we're getting from Israel and all the comments, both public and off the record, that we're getting are that Israel is gearing up for the war in Gaza to last for many months to come. They have a very clear set of priorities, which is basically to eliminate the Hamas leadership, and they can't do that if they agree to a permanent ceasefire now. So whether you can find some sort of compromise in there somewhere where you have perhaps a couple of weeks of ceasefire, you have some release of hostages, you have some release of Palestinian prisoners, then we'll see. But it's not looking great at the moment. However, as you said, Blinken's back in the region, or he will be shortly. And, he's, I think, his fifth or sixth tour now. And if he's coming, maybe that gives us some ground for hopes that they can reach some sort of compromise. But will it be a permanent ceasefire? That feels incredibly unlikely right now.
Yeah, absolutely. Shuttle diplomacy. Stuart, thank you so much for your time this morning. That is Bloomberg's head of Middle East and North Africa coverage, Stuart Livingston-Wallace.
Meanwhile, there have been more wild swings on Chinese equity markets today. The markets having lost $1 trillion in market cap in 13 days trading. Authorities in China vowed to stabilise markets. With the details now, we're joined by our executive editor for Asia Markets, Paul Dobson. So we've had a statement from the China Securities Regulatory Commission on Sunday, and what turned out to be an extremely volatile session today.
Absolutely. It's been keeping us on our toes for sure. So the market's initial reaction was one that was pretty unimpressed to the statement that we had over the weekend. We're in, a situation where we're demanding action, not talk. And so promises is not really enough to sustain goodwill in the market. And so lo and behold, everything sank again at the open, led in particular by the small caps, which came under an immense amount of pressure. One of the gauges, the CSI 1000 gauge, which is one of the Shenzhen markers in particular, was down with 990 of the 1,000 constituents or thereabouts, all in the red at one point. So pretty much right across the board, some selling. Then, as we got towards the lunchtime break, markets started to pull back a bit, and we had some more strong words from the regulator, which sounded like they might have a little bit more teeth behind them. And perhaps, most of the selling had already been done in the morning session, and it ran out of gas a little bit and allowed us to sort of pare some of the losses and then bounce back a little bit into the afternoon as well.
OK, so a couple of statements from the authorities. But look, overall, there has been a huge loss of confidence. Mm-hmm. Why, and can that be turned around?
Yeah, well, there's a big picture reason and a smaller reason within that. I think, the equities have been under pressure for most of the past year. We had a big rebound this time last year on the recovery trade, but that didn't really see huge follow through in terms of economic traction. The market wanted more stimulus, wasn't getting it. The authorities were happy with a kind of 5%-ish growth pace. But within that, there was, this disinflationary impulse going on. Price price wars among retailers, and in the background, the really bad, nasty property crunch as well, which really ground down consumer confidence and has left market optimism kind of shattered in some ways. Now, shorter term, the most immediate or the most recent moves that we've seen have started to trigger some stop loss or automatic losses in derivatives, and also most recently in shares that were pledged by company owners or directors, those kinds of things. They would pledge them in order to borrow more and invest in other areas as well. Those have hit margin call areas and are starting to be either liquidated, or people are demanding more collateral against the money that's been put up. So it's causing a bit of an ugly mess. There's money flowing out of mutual funds. There's a real broken confidence onshore as well. And so it's all sort of snowballing worse and worse at the moment.
This is Bloomberg Daybreak Europe, your morning brief on the stories making news from London to Wall Street and beyond.
Look for us on your podcast feed every morning on Apple, Spotify and anywhere else you get your podcasts.
You can also listen live each morning on London DAB Radio, the Bloomberg Business app and Bloomberg.com.
Our flagship New York station is also available on your Amazon Alexa devices. Just say, Alexa, play Bloomberg 1130. I'm Caroline Hepker.
And I'm Stephen Carroll. Join us again tomorrow morning for all the news you need to start your day, right here on Bloomberg Daybreak Europe.